5 stocks under $20, January 2019 edition. My name's Jeff Beers. This is the 40 Finance channel, and today I'm taking a look at 5 stocks under $20, which I think both either have potential or are just plain fun to look at. So I dug them out for you. This is my new channel looking at stock market investing, personal finance, how to make more money. Please subscribe and like this video if you enjoy the content. Let's dig in. All right, number one on our list is the Michaels Company, ticker symbol MIK. Michaels is a retail store that my wife frequents quite a bit. They sell mostly crafts, decorations. It's kind of like a craft superstore. They also do a lot with picture framing, home decor, anything like that. It's big for teachers, which is my wife. It's also big for the craft industry, the Etsy industry. All those things are kind of growing, and Michaels is doing a pretty good job in a very tough retail space. Looking at Michaels fundamentals, you got a P/E ratio over the last 12 months of 8.37. You got a forward PE of 6.29. So obviously the falling P/E ratio is good news. It means margins are getting better and or revenues are projected to go up. I like to look at debt ratio for the health of a company. Their current debt ratio of 1.31 is not too bad. In a perfect world, you're under 1 and you're closer to like 0.6, something like that. But I will tell you that this day and age, 1.31 is probably just above average. However, they are going to invest in new stores, keeping stores looking great, and new technology and all those things. So this debt ratio seems fair as long as they can produce the revenue. Over the past 5 years, Michaels has had sort of a roller coaster ride. You can see 5 years ago, their stock was just about where it is today. And they've been up and down and up and down. What I've looked through in their past few quarters has been pretty good news. So they've hit most of their earnings estimates and they're projecting pretty good things for 2019. One of the big things I'd look for out of Michaels to pay attention to is probably a CRM system or some sort of digital-based way to connect with customers, not only through e-commerce, but also to interest customers in visiting the store. I think in this sort of craft home decor world, e-commerce is probably not as big. Michaels is a destination. It's a place that you go and you look around and you think about your projects and you pick out the certain things you want. So I think it's important that people get to the store. Obviously, this day and age, you have to have an e-commerce site, but I think more importantly for them, can they grow their CRM suite and really connect with folks? All right, number 2 on this list is Wendy's, the fast food restaurant. So ticker symbol WEN. Wendy's is a pretty interesting case when I dug in here. Their current PE ratio is 6.76. But as you see up here, and I even put a question mark there, 24.85 is their projected forward PE. So a substantial jump. You also have a pretty high debt ratio here at 2.53. So I had to get in and look around a little bit to see what exactly is going on. And it's pretty interesting. So Wendy's is in the midst of a huge capital infusion into their entire chain, okay? They've switched over to a franchise model that's been going well. They also, though, with that franchise model, they are buying back poor performing stores and antiquated stores. They're bringing them into the company. They're sort of remodeling them, fixing them, and selling them back to a new franchisee. So it's a very interesting model. They've also spent a lot of money on new technology that drives the business, new restaurant enhancements, and then international expansion. So the key with Wendy's right now is, can you come in low as an investor, buy for $16, say today? Do you believe in the franchise model after doing your research? Do you want to get in low now and see where this lands in, let's just say, 3 years? Because that's probably the next time that you're going to see debt ratio come down. My guess is it's obviously going to take all of 2019. Wouldn't be surprised if it's a 2020 thing as well. And then you start to look at the returns on those gains. So it's worth looking at. You can't beat the price as an individual at $16, and it does have a very small dividend, although not that small at 2%, but the price being so low, looks like you'll get about 30 cents a quarter out of that. So Wendy's, I think, is intriguing, and it's definitely one to watch. And if you're into food or you know a lot about the food industry, you can compare it with other restaurant chains and see if it's a match for you. All right, next on our list is Zagg, ticker symbol ZAGG. Zagg, if you've run into them before, they're a third-party creator of phone accessories, right? So if you're not going to pay Apple $100 for an earbuds or whatever the latest thing is, Zagg makes cases, covers, screens, anything that could hook up to your phone, protect your phone. They offer an inexpensive solution for. They distribute those across a lot of discount shops across America, places like Walmart, Target, and then they have their own shops within some malls in America too. The P ratio for Zagg in the last 12 months is 9.55, and looking ahead, it drops to 6.68. So we definitely have some forward-looking positives for Zagg. The debt ratio at 1.76 is, again, a little bit over the comfort zone of, I would say, 1 to 1.25. However, the interesting thing about this, as I read through this company, is the more new phones that come out, the better that they do. So every time, and this makes sense if you think about it, every time there's a new Apple, there's a new Samsung, you name it, obviously the sizes of those phones tend to change, the capabilities change, and there'll be a rush on new accessories. I think that 2019 will be a pretty big year for cell phones, our mobile phones. I know for sure that Samsung's got a couple new ones coming out, and so does Apple. So if they change shape or dimensions that require new screens and people do not want to pay a premium price for first-party accessories, Zagg could really benefit here. So do your homework on Zagg. I think it has some potential. Yahoo has a target estimate of $18.40 over the next 12 months. So there could be an opportunity here to double your money. Just make sure you do your research and compare where their retail outlets are, how they're performing in retail, because this debt ratio can also work against them if things don't go the way they plan. Okay, stock number 4 is just one that caught my eye as sort of a fun one. Speedway Motorsports, ticker symbol TRK. When I was sorting through lists, I originally thought it was the Speedway gas stations, and I thought that that could be a really interesting company. That is not the case here, but it's still a really interesting company. Speedway Motorsports owns 5 or 6 large auto racing tracks in the United States. I'm not a huge racing fan, so I don't know all these, but there's a big one in Charlotte Motor Speedway. There is one in Atlanta. They have one in Northern Kentucky, which is a stone's throw away from my house. And then a couple others that I sort of recognize the names briefly. Speedway puts on events and drives sponsorships and sells tickets. That's what they do. There is a full calendar of race activity that they try to incorporate into their stadiums. And it's a really interesting business. It's probably one more for someone who's passionate about auto racing and knows some subtleties about auto racing, like where the market's going, where will it be in 10 years from now, that would help investors make a good case here on whether to buy or sell. The PE ratio at 4 is hard to beat. The forward PE jumps quite a bit to 15.97. I'm guessing for capital improvements of some kind. And the debt ratio, again, a little near the uncomfortable zone of 1.73. They do have a very healthy dividend at 3.68%. So there's probably something here with Speedway. I don't think you're going to make $1 bazillion off investing with them. But if you're passionate about racing and you have sort of an inside edge on where racing might go and how it might benefit Speedway Motorsports, it might be a fun research project and a pure speculation play. All right, last stock in our 5 stocks under $20 sneaks in right below the $20 mark at $19.71, and that is the Symantec Corporation. So Symantec is best known for their antivirus software that runs on computers. They now also offer the same service for mobile phones, Internet of Things, like TVs, refrigerators, whatever is out there. And they've done really well in that space. The #1 competitor for them is McAfee. There's also obviously several others in the space. But Symantec has performed pretty well. You see the P/E ratio of 10.94. The forward P is 11.2. The debt ratio is one of the healthiest in this presentation today at a solid 1. But yet, over the 5 years, they've had a lot of ups and downs, most notably downs since about 2017. Now, the stock market ebbs and flows is part of that. But the other thing that came up that I researched and found out is they had some accounting inefficiencies, not really anything too brutal. There wasn't like executives stealing money, and I don't think that they were falsifying tax information or anything like that. But they did require a full audit of their accounting department. They're still going through that today. I think folks freaked out a little bit because we all know, accounting concerns can lead you to some dark places as a company. It doesn't look like Symantec is going to come out of this with any major penalties. I'm sure there will be fees and fines involved. But what you have here is potentially an opportunity to get Symantec maybe later in the year after some of these clouds have passed, get it on the cheap, and then see what happens over the next couple years. They're obviously in a growth industry, right? Cybersecurity is not going down anytime soon. We're only going to need more things. So look into Symantec's research and development pipeline. See if there's anything there. Maybe pick it up after the storm clouds have passed and you could make some money. Okay, so those are the 5 stocks under $20 for January. Hope you guys enjoyed this. If so, please like and share this video with your friends as I'm trying really hard to grow the channel. My name's Jeff Beers. This is 40 Finance. We'll see you on the next video.